The American dining empire is crumbling, and the collapse is happening faster than anyone predicted. Across the country, restaurant chains that seemed untouchable just years ago are now fighting for survival against forces they never saw coming. What you're about to discover isn't just another clickbait list. These are hard facts backed by financial reports, industry data, and insider revelations that paint a terrifying picture of an industry in free fall. Some of these brands are already preparing their final acts. Others are hemorrhaging money with no end in sight. And a few are making moves so desperate they're essentially admitting defeat. The shocking truth? The restaurants dying aren't just the obvious casualties. Some of the biggest names in American dining, brands you drive past every day, are quietly planning their exit strategies while pretending everything is fine. Stay with us to the end, because the final names on this list will leave you questioning whether any restaurant chain is truly safe. Number 1. Panera Bread. The fast casual pioneer that convinced America to pay $12 for soup and a half sandwich is discovering that clean eating doesn't guarantee clean profits. Panera's premium positioning has become its greatest weakness, as inflation-weary consumers abandon overpriced cafe food for cheaper alternatives that offer superior value and convenience. The chain's signature You Pick Two combo now costs nearly $16 in most markets, pricing that's pushed families toward grocery stores and food trucks that offer better value. But the real crisis runs deeper than simple pricing issues. Panera's attempt to automate with self-serve kiosks and reduced staff has created a customer experience that feels impersonal and rushed, destroying the cozy cafe atmosphere that once justified premium pricing. Franchise owners are reporting devastating losses, with many locations seeing foot traffic drop 40% since 2023. The bakery concept that once differentiated Panera has become a liability, as day-old pastries and bread waste money, while fresh options from grocery stores offer better quality and convenience. Internal documents reveal that food waste alone costs the average location $2,800 monthly, while labor inefficiencies from undertrained staff add another $3,200 in lost productivity. Recent efforts to compete with delivery apps through subscription models have backfired spectacularly, creating customer acquisition costs that exceed lifetime value by an average of $47 per subscriber. The Sip Club Unlimited coffee subscription that was supposed to drive loyalty has instead created a customer base that visits solely for free beverages while avoiding food purchases. When your loyalty program loses money on every member, you're not building a business. You're funding your own extinction. The competitive landscape has shifted dramatically against Panera's favor. Local coffee shops offer superior atmosphere and community connection, while fast casual competitors like Sweetgreen and Kava provide fresher, more customizable options at comparable prices. Even Starbucks has evolved beyond Panera's capabilities, offering better mobile ordering, faster service, and more convenient locations. Number 2. Chipotle. The Mexican chain that seemed recession-proof is facing a reckoning that could shatter its carefully crafted image. Behind the food with integrity marketing lies a company struggling with operational chaos that's finally catching up to them in ways that threaten the entire brand foundation. Portion control scandals have exploded across social media, with customers documenting increasingly smaller servings while prices continue climbing relentlessly. The famous Chipotle bowl that once felt like genuine value now costs $15 plus, and often leaves customers hungry and frustrated. Internal training videos leaked in 2024 revealed corporate mandates to reduce portion sizes by 15 to 20% while maintaining prices, essentially stealing value from every customer transaction. Food safety issues continue to plague the brand despite years of supposed improvements and millions invested in new protocols. Every E. coli outbreak or norovirus incident costs millions in lost sales and legal settlements, creating a reputation crisis that marketing budgets can't overcome. Recent internal documents reveal the company has quietly increased insurance premiums by 300% to cover potential health-related lawsuits, adding $2.3 billion, $1 million annually to operational costs per 100 locations. Labor relations have deteriorated dramatically, with workers organizing at unprecedented rates and exposing working conditions that contradict the company's ethical branding promises. Union organizers report that turnover rates exceed 150% annually at many locations, creating operational instability that directly impacts food safety and service quality. When your employees become your harshest critics, maintaining a positive brand image becomes virtually impossible. Competition from local fast casual Mexican restaurants offering better food, larger portions, and more authentic experiences at similar prices is devastating market share in key demographics. Qdoba, Moe's, and dozens of regional chains are capitalizing on Chipotle's reputation problems while offering superior value propositions that appeal to cost-conscious consumers seeking authentic Mexican flavors. Number 3. Subway. The world's largest restaurant chain by location count is imploding from within, proving that massive scale becomes a liability when your business model fundamentally breaks down. Subway's Eat Fresh promise has become a punchline as quality control disasters and franchise rebellion threaten to topple the entire empire that once seemed invincible. The infamous foot-long lawsuits revealed systematic deception that destroyed consumer trust permanently and continues to haunt the brand years later. When customers discover your 12-inch sandwich is actually 11 inches, and your fresh-baked bread contains yoga mat chemicals, recovery becomes nearly impossible. Class action settlements have cost the company over $500 million, but the reputational damage proves far more expensive than any legal payout. Franchise owners are in open revolt, filing hundreds of lawsuits over predatory corporate practices that prioritize corporate profits over franchisee success. Required renovations cost $300,000 plus per location, while generating no measurable additional revenue, forcing many operators into bankruptcy. Mandatory technology upgrades drain franchisee profits while creating systems that break down constantly and frustrate customers who expect seamless digital experiences. Store closures have accelerated dramatically. Over 1,200 locations shut down in 2024 alone, with the pace increasing quarterly as economic conditions worsen. When your business model depends on franchisees who can't generate profits, systemic collapse becomes inevitable. The corporate response has been to blame franchisees for poor execution, while implementing even more costly mandates that make profitability impossible. The brand's desperate attempts at menu innovation have confused rather than excited customers who came to Subway for simple, predictable sandwiches. Adding pizza, wraps, salads, and breakfast items while maintaining sandwich preparation methods has created an identity crisis that appeals to no demographic. Quality complaints flood social media as overstretched staff struggle to prepare dozens of different items with equipment designed for basic sandwiches. Behind the scenes, corporate executives are reportedly exploring strategic alternatives, including potential sale or bankruptcy protection. When the world's largest restaurant chain by location count can't generate sustainable profits, it signals fundamental problems that threaten the entire franchise restaurant model. Number 4. Buffalo Wild Wings. The sports bar chain built on wings and beers discovering that both pillars are cracking simultaneously. Wing prices have exploded 40% in 2 years, turning their signature product into a luxury item. A dozen traditional wings now cost restaurants $8 to $10 in ingredients alone, forcing menu prices that shock customers. Meanwhile, alcohol sales, historically 30 to 40% of revenue, are plummeting as younger consumers drink less and prefer experiences that don't revolve around sports bars. Sports viewing habits have fundamentally changed, with streaming services providing better experiences than crowded, noisy restaurants. Number 5. Pizza Hut. The Red Roof pizza pioneer that once ruled family dining is barely surviving in a market it helped create. Over 500 locations closed permanently in 2024, with closures accelerating each quarter. The brand's attempt to maintain both dine-in and delivery models has created the worst of both worlds: slow delivery and empty dining rooms. Domino's technology-first approach has made Pizza Hut look antiquated by comparison. Franchise defections are mounting as operators struggle with impossible economics. Parent company Yum! Brands has quietly begun exploring strategic alternatives, corporate speak for preparing to sell or shut down. Number 6. Applebee's. Eating good in the neighborhood has become barely surviving in the strip mall. The brand's famous 2 for $20 deal now costs closer to $30 in most markets, pricing out the budget-conscious families that built the chain's success. Efforts to attract younger diners have spectacularly backfired. Social media campaigns featuring influencers have alienated existing customers without gaining new ones. The brutal truth: Applebee's exists in a no-man's land between fast food and fine dining, offering neither the convenience of one nor the experience of the other. Number 7. Red Lobster. The seafood chain is drowning in the very promotions that made it famous. The endless shrimp deals that once packed restaurants are now bleeding the company dry, with analysts estimating losses of $7 to $9 per customer on promotional offerings. Seafood cost inflation has created an impossible equation: maintain prices and lose money on every sale, or raise prices and lose customers. Supply chain disruptions have made menu consistency impossible, while attempts to modernize with delivery have revealed that seafood doesn't travel well. Number 8. TGI Fridays. Thank God it's Friday has become thank God we're still open. Barely. The brand's core concept, happy hour and social dining, has been devastated by changing social habits and work patterns. Remote work has eliminated the traditional Friday happy hour crowd. Financial distress has forced widespread cost-cutting that's destroyed the service and atmosphere that differentiated Fridays from competitors. The brutal reality: TGI Fridays represents a vision of American social dining that no longer exists. Number 9. Olive Garden. When you're here, you're family. But this family is about to declare bankruptcy. Each table's unlimited breadsticks, salad, and soup now costs restaurants $10 to $14 in ingredients alone. When your signature promotions lose money on every customer, you're funding customer dining rather than building a business. The generational divide has become a chasm. Younger diners view Olive Garden as overpriced and inauthentic compared to fast casual Italian options. Same-store sales have declined for 9 consecutive quarters while operational costs increase monthly. Number 10. Boston Market. The rotisserie chicken chain has become synonymous with lawsuits, labor violations, and irrelevance. Legal troubles have consumed the company's resources. Wage theft claims, unsafe working conditions, and franchise disputes have created a toxic environment that's driven away both employees and customers. Grocery stores offer superior rotisserie chickens at lower prices, while fast casual competitors provide fresher alternatives. When Costco provides better rotisserie chicken for half the price, your entire business model becomes obsolete. Number 11. Denny's. The 24/7 diner is discovering that round-the-clock service has become round-the-clock losses. Rising labor costs have forced most locations to abandon overnight operations, destroying the core value proposition that differentiated Denny's from competitors. The Grand Slam breakfast now costs $16 plus in most markets, pricing that pushes customers toward faster, cheaper alternatives. Cultural shifts have eliminated much of Denny's customer base as diner culture gets replaced by food delivery. Number 12. Chuck E. Cheese. The childhood birthday party empire is facing extinction as entertainment preferences shift toward digital experiences. Post-bankruptcy and burdened with nearly $2 billion in debt, Chuck E. Cheese represents everything modern families want to avoid. Kids today prefer tablets and gaming consoles over mechanical games. Food quality has become a running joke, while the party business has collapsed as families choose alternatives like trampoline parks that offer better value and experiences. Number 13. Golden Corral. The all-you-can-eat buffet king is choking on post-pandemic health concerns and unsustainable food costs. The shared serving model now feels dangerous and unsanitary to health-conscious consumers. Rising ingredient costs have made the buffet model economically impossible. When protein costs increase 40%, but buffet prices can only rise 15% without losing customers, every diner becomes a financial loss. Number 14. Cracker Barrel. The country store restaurant is learning that old country charm doesn't translate to modern profits when your target demographic is literally aging out of existence. The gift shop model has been devastated by online shopping, while younger consumers view the brand as irrelevant. Geographic concentration in markets with declining populations has made growth impossible while increasing vulnerability to economic downturns. Number 15. Hooters. The restaurant concept now feels antiquated and problematic to modern consumers. Cultural shifts around workplace equity have made Hooters a target for criticism and boycotts. Beyond cultural issues, the food quality simply isn't good enough to justify the controversial concept. Competition from sports bars that offer better food without controversial atmosphere has captured much of Hooters' traditional customer base. Number 16. Friendly's. The ice cream and burger chain is melting away faster than a Sunday in August. Multiple bankruptcies and ownership changes have left Friendly's without clear identity or sustainable business model. The brand's signature ice cream faces brutal competition from premium brands, while restaurants serve mediocre food at premium prices. Geographic concentration in declining markets has made expansion impossible. Number 17. Long John Silver's. The fast food seafood chain is sinking under quality perception problems and impossible economics. Once a popular alternative to burger joints, Long John Silver's has become synonymous with poor food quality and health violations. Seafood cost inflation has made the value proposition impossible to maintain, while social media amplification of negative experiences has created reputation crises that traditional marketing can't overcome. Number 18. White Castle. The original slider pioneer is sliding toward extinction despite maintaining a cult following. The novelty of tiny burgers has worn off as gourmet burger options proliferate. Geographic limitations have prevented economies of scale that could help weather current challenges, while rising operational costs in urban markets have made the small format restaurants unsustainable. Number 19. Burger King. The have it your way King is about to abdicate. Once McDonald's fiercest rival, Burger King has become an afterthought in the fast food wars. Same-store sales have plummeted for 6 consecutive quarters while operational issues plague the chain. Their marketing stunts have confused rather than excited customers, while outdated restaurants feel stuck in the 1990s. Parent company Restaurant Brands International has quietly begun exploring strategic alternatives. Number 20. Sizzler. The steakhouse chain that once boasted over 600 locations now operates fewer than 10 restaurants in the entire United States, representing one of the most dramatic collapses in restaurant history. The few remaining locations struggle with outdated equipment and business models that made sense in different economic conditions. The Sizzler story serves as a warning. Consumer preferences can shift so dramatically that even successful brands become obsolete overnight. The deeper crisis. Why this is just the beginning. What we've revealed represents only the first wave of a transformation that will reshape American dining forever. The restaurant apocalypse isn't coming, it's already here. The economics of impossible math. The fundamental economics have broken down completely, creating mathematical impossibilities that no amount of operational efficiency can solve. The average casual dining restaurant that needed $2.2 million in annual revenue to be profitable in 2019 now requires $3.4 million to achieve the same margins. A 55% increase that far outpaces any reasonable growth expectations or consumer spending patterns. Labor costs have increased 45% since 2020, driven not just by minimum wage increases, but by competition for workers who now have alternatives to restaurant employment. Food costs have jumped 35% due to supply chain disruptions, climate change impacts on agriculture, and global economic instability that shows no signs of improving. Insurance premiums have doubled or tripled as restaurants become higher-risk investments. Energy costs have skyrocketed, adding thousands monthly to operational expenses. Meanwhile, consumer spending on dining out has actually decreased 12% when adjusted for inflation, creating a devastating scenario where restaurants need dramatically more revenue while customers are spending significantly less. This isn't a temporary adjustment. It represents a fundamental shift in how Americans allocate their food budgets, with home cooking and grocery shopping, capturing market share that restaurants may never reclaim. The delivery app economy that promised salvation has become a trap that many restaurants can't escape. Platforms charge 25 to 35% commission on every order, turning previously profitable sales into break-even propositions at best. Restaurants that refuse to participate lose customers to competitors, but those that do participate often lose money on every transaction. The math becomes impossible. You need delivery to compete, but delivery makes you unprofitable. Credit markets have tightened dramatically for restaurant operators as lenders recognize the industry's fundamental instability. Equipment financing that was readily available just 3 years ago now requires personal guarantees and higher interest rates. Commercial real estate loans for restaurant properties have become nearly impossible to obtain, forcing operators to accept lease terms that guarantee eventual failure. The Small Business Administration, traditionally a lifeline for restaurant operators, has quietly shifted lending priorities away from food service businesses. Internal documents reveal that restaurant loan default rates have exceeded 40% in many markets, making the entire sector essentially unbankable under traditional credit standards. Working capital requirements have exploded as suppliers demand faster payment terms, and inventory costs increase unpredictably. Restaurants that once operated on 30-day payment cycles now face demands for immediate payment or cash-on-delivery terms that strain cash flow beyond breaking points. When your suppliers don't trust your industry to survive, operational stability becomes impossible to maintain. The generational abandonment. The most brutal reality facing these chains is that an entire generation has moved on completely and they're not coming back. Gen Z and younger millennials don't just prefer different restaurants, they have fundamentally different relationships with food, dining, and social experiences that make traditional chain restaurants irrelevant to their lifestyles and values. They'd rather spend $18 on a customizable poke bowl that aligns with their health and sustainability values than $25 on a predetermined pasta dish at Olive Garden that feels processed and inauthentic. They want experiences that are photo-worthy and shareable, not just filling. Instagram and TikTok have created expectations for visual appeal and uniqueness that standardized chain restaurants simply cannot meet without completely abandoning their operational models. Most devastatingly, they're comfortable eating alone, ordering delivery, or meal prepping instead of using restaurants as social gathering spaces. The family dinner out tradition that built these empires has been replaced by DoorDash while binge-watching Netflix, or meal prep Sunday rituals that eliminate the need for restaurant dining altogether. Their values around sustainability, ethical sourcing, and corporate responsibility create impossible standards for large chains to meet. They research where their food comes from, how workers are treated, and what environmental impact their dining choices create. Legacy chains built on cost efficiency and standardization can't compete with local restaurants that offer transparency and authenticity. The economic reality is even more stark. Younger consumers have less disposable income due to student loans, housing costs, and stagnant wages, but they're willing to spend premium prices for experiences that align with their values. They'll pay $20 for a bowl at Sweetgreen because it represents their identity, but they won't pay $15 for a meal at Applebee's because it represents everything they want to avoid. Social media has amplified their influence beyond their spending power. A single negative TikTok video can reach millions of viewers and damage brand reputation more effectively than traditional advertising can repair it. These consumers don't just choose different restaurants. They actively campaign against brands they view as outdated or problematic. The generational wealth transfer happening over the next decade will put trillions of dollars in the hands of consumers who have already demonstrated they won't support traditional chain restaurants. The baby boomers who built these chains' customer bases are aging out, while the generations replacing them have fundamentally different preferences and spending patterns that favor local, sustainable, and authentic dining experiences. The supply chain catastrophe. Behind every restaurant failure lies a supply chain story that reveals the terrifying fragility of modern food systems and the global dependencies that can destroy local businesses overnight. The chicken shortage that started in 2021 never really ended. It just became more expensive, unpredictable, and politically complicated as trade policies and climate change create permanent instability. Global supply disruptions mean a drought in Argentina can destroy burger chains when beef prices double overnight, while trade disputes with Asia can eliminate seafood concepts entirely. A single storm in Mexico can make guacamole financially impossible for months, while bird flu outbreaks can force complete menu changes that confuse and alienate customers. These chains built their brands on consistency and predictability, but consistency has become impossible when core ingredients are subject to forces completely outside their control. Even basic ingredients like cooking oil, cheese, and lettuce have become budget busters that force menu changes customers hate. Soybean oil prices have increased 180% since 2020 due to biofuel demand and climate impacts on production. Cheese costs have become so volatile that some chains have implemented market pricing models that adjust daily, destroying the price predictability that budget-conscious families require. Transportation costs have exploded as fuel prices increase and driver shortages create delivery delays that spoil perishable ingredients. Cold storage costs have tripled in many markets as energy prices climb and refrigeration becomes a major operational expense. Some chains report that transportation and storage now represent 25% of total food costs, compared to 8% in 2019. Labor shortages in food processing plants have created bottlenecks that affect every restaurant chain. When meatpacking plants can't maintain full production due to worker shortages, the ripple effects impact pricing and availability throughout the entire food system. Some processors have implemented allocation systems that limit how much product restaurants can purchase, forcing menu planning around availability rather than customer demand. Climate change impacts are becoming permanent features of supply chain planning, rather than temporary disruptions. Extreme weather events now occur with sufficient frequency to make long-term supply contracts meaningless. Restaurants that once planned menus 6 months in advance now struggle to guarantee ingredient availability 6 weeks ahead, making marketing campaigns and operational planning nearly impossible. The consolidation of food suppliers has created monopolistic conditions where restaurants have few alternatives when suppliers raise prices or change terms. When 3 companies control 80% of beef processing, restaurants lose negotiating power and become price takers rather than price negotiators. This consolidation has accelerated during recent economic disruptions, leaving restaurants more vulnerable than ever to supplier decisions. The coming tsunami. Industry analysts predict that 2025 will see the largest wave of restaurant bankruptcies in American history. At least 4 major restaurant companies are expected to file for bankruptcy protection, affecting thousands of locations and hundreds of thousands of jobs. The restaurants thriving in this environment are typically small, local, flexible operations that can adapt quickly. The chains we've profiled were built for a world that no longer exists, serving customers who have moved on, with business models that economics no longer support. The final warning. The next time you drive past a familiar restaurant sign, remember that you might be looking at a piece of American history that's about to become exactly that: history. The casual dining chains that shaped how we eat, celebrate, and socialize are disappearing faster than anyone imagined possible. The restaurant apocalypse is accelerating, and the casualties are mounting. The age of the American restaurant chain is ending, and what comes next will be unrecognizable to anyone who grew up with these brands. Consider yourself warned. The dining landscape you've known your entire life is disappearing, and it's not coming back.